How to stop impulsive, undisciplined trading. Stay tuned, traders. You don't want to miss this one. Good day, traders. Stacey, Burke from Stacey Burke Trading. Today we're going to be talking about how to break the pattern of impulsive trading and undisciplined trading. So if a lot of retail traders, they go through similar journeys to the one that I was on and one I've been on, blowing up small accounts, taking trades after having a fairly good run of some profitable trades and jumping back into the markets because you're out of the market and you want to get back in. The testosterone's elevated, the adrenaline's elevated, and you have irrational exuberance, as Alan Greenspan once coined, and you've got this euphoric state where you just got to be back in the market. And part of that is, you know, you're by nature, we want to hunt things and we want to have that heightened excitement, and we chase things and we go after them and we turn our screen on immediately. We want to look for a trade and jump into the market rather than having a methodical approach where we sit back and wait for the market to set it up for us, so that all we have to do is, like Jim, I forget his name, said he wants to go over and pick the money up off the floor, the easy money, when it's just sitting there to take. Then there's the other emotional trades where we get angry and we get frustrated and we jump into a trade because we've taken some losses. We want to make that money back. We over leverage. We want to make it back on one or two trades. We're angry. We're frustrated. We're impatient. We're impulsive, and that's where we can really come unstuck and do some massive damage to your trading account. It's obviously undisciplined, but this is where overcoming that, it comes back to your daily routine. And we talk about this by getting my 7-step daily routine for high performance traders. It's about working on your mindset, but also your edge in terms of understanding, as a trader, your role is to, number one, preserve capital, but also to look for, number two, geometric patterns that give you an asymmetrical risk reward opportunity. So you're not just trying to jump into the market and scalp trades. You can do that, but most likely you're going to end up getting chopped up at some point because of the haphazard approach that you're taking. And one of the main reasons I went back to completely end-of-day trading was that it allows me to, at the rollover of New York, take a position or put an order into the market with my stop loss predefined, my position sizing predefined, and then I'm off the screen until the next morning to check it. And what that prevents me from doing is perhaps trying to, the market may actually go against me for 3/4 of that daily session and then reverse it into the London close and completely move overnight and put me into profits. But if I was watching that intraday, I might panic, or I might average into a losing trade, which could end up blowing up on me, or I could move my stop loss for fear of taking too big of a loss, which was again predefined before we entered into the market. You might rethink your original entry and then reverse a position. So you might be long and then intraday decide to go short, and then again it reverses, and if you'd stayed in your end of day trade, you would have ended up profitable at that point, or positioned into a beginning of a move. So the discipline comes, number one, from understanding what your primary role is, and that's preservation of capital. When you approach the markets from that perspective, you understand that the next trade you take is most likely going to be a loser, and you'll position size and manage your stop loss or your downside accordingly. But you'll also be looking for these geometric patterns, like we talk about, studying Peter Brandt, Schaubacher, Edwards and McGee, the classical charting, or these measured moves, these patterns that have been around and they show up over and over again, regardless of the time frame that you're trading on, so that you have a skewed profit or a positive expectancy that's giving you greater return on average for each winning trade than your losing trades are taking out of your account. So impulsive trading comes when you, I think, number one, don't understand what you're doing. Number two, when you're coming to the market with emotional baggage and unrealistic expectations, so you're not emotionally orientated. And number three, you're not coming to the market understanding what your primary role is, and that's to manage your capital and to look for these geometric patterns where you have an opportunity to position yourself with a smaller amount of risk than what the rewards could possibly generate if it's a profitable trade. So I encourage you to go back, work on this in my 7-step daily routine. One of the things is preparation. Having a daily routine in terms of how you approach the markets, journaling your trades, learning something each day from the market. What are you doing well? What could you do better? And then the next week or the next day, employing that and working on one thing each week and trying to master one component of your trading each week so that you're moving in a direction of constant progress. Now, if you're losing over and over again and you're looking for the holy grail of entries and exits, there's some really basic stuff that works. But again, if you're impulsively turning the screen on randomly at any time of the day or just looking at the markets and taking a position into the markets, there's no consistency to that approach that you can duplicate over and over again. And one of the reasons I like the end of the day is that, again, the rollover time is, like Ray Dalio talks about. What do we know to be true? Well, I know every day that the market begins trading again with Asia. And Monday to Friday, there's a weekly ATR and there's a monthly ATR. The market, you put your monthly charts up and you start to study the opening ranges of the weeks and the months, you'll start to understand even more so where these opportunities present themselves. So impulsive trading, undisciplined trading comes from not having a methodology and a systematic approach to the markets. It comes from not having the emotional orientation to keep your expectations realistic, and it also comes from not understanding number three, again, just these geometric asymmetrical risk rewards. So don't risk 10 pips to make 10 pips. Don't risk 30 pips to make 20. Risk 60 to make 400 or 500 or 700 pips. These are the types of trades that I'm looking for. These are the types of trades that are going to wipe out your losers, and these are the trades that are going to give you the opportunity to significantly add profits to your trading account. So hopefully you got some value from today's video, traders. Again, systematic methodology, preservation of capital, and asymmetrical geometric risk reward trading patterns. Have a great trading week, and may the markets go with you. Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.